Problems 916 and 917 from Chapter 9 of the CFA Institute textbook, Corporate Finance, A Practical Approach, both use the same income statement and balance sheet exhibits for La Perla, so those are reproduced here. Suppose that La Perla's revenues are expected to grow at a rate of 10%, and all elements of the income statement and balance sheet are sales driven except for the tax burden, which remains at 30%. Then we're told we want to know that their net income is closest to however much. Okay, so revenue goes from the current year up 10%. Cost of goods sold goes up 10%. Selling, general, and admin goes up 10%. Interest expense would not go up 10%, given in the problem, but that doesn't make any sense. And we end up with $2.5 billion. So just project out the numbers and see where they take you. All right, if their long-term debt and paid-in capital accounts remain at their 2005 levels, which would cause their interest expense to stay at the same level, just saying, the tax rate remains the same, and all other statement and balance sheet sales-driven expected growth rate of 10% 2006, La Perla will have a financing what? Okay, it's a deficiency if it pays no dividends, surplus if it pays out 50% in dividends, deficiency if it pays out 50%. All right, so let's go take a look. Their current assets, if the current assets grow by 10%, net property, plant, and equipment grows by 10%, then total assets will grow by 10% from $20 billion to $22 billion. Current liabilities grow by 10%. The problem said leave long-term debt and common stock paid-in capital the same. Our retained earnings goes from $13.5 billion to $14,750,000 if we pay out 50% of the income as dividends. So if it doesn't pay any dividends, the amount that this would grow would be $15,964, and you'd have a surplus. So if there were no dividends, so if it increased by all of net income, you'd have too much money. If it pays out half as dividends, the retained earnings only goes up $17,732, which leaves a deficit. And we have a conflicting answer because interest expense doesn't change. If that conflicts with the problem statement that everything is sales driven, debt stays the same, interest expense should stay the same. In any way, it's kind of tortured language and could have been written better. But bottom line is, if the surplus, there will be no surplus if it pays out 50% of dividends, so that's a big no. A deficiency, that's a yes. If it doesn't pay any dividends, though, it'll actually have a surplus. So the correct answer, which you can get by just plugging numbers, if this went up 20 to 22 and everything but long-term debt and common stock went up by 10%, so the retained earnings went up by either the retained earnings went up by the full amount of net income of $2.5 billion. You would have a surplus, no deficiencies. All right. So by paying out 50% as dividends, you end up having a deficiency of roughly $650 million.